So I think without further ado, really, we should start today's webinar. Keep the names coming. It's great to see who's on today's webinar. And I'm going to officially welcome everybody. So welcome to this afternoon's webinar with Digital Frontiers Institute. It's a pleasure to be here with you. For those of you that don't know me, my name is Sarah Corley and I'm the Divisional Director for Community at Digital Frontiers. So it's really exciting for me to be on another webinar. And what an exciting topic today. So this is a topic I think many of us are passionate about. So financial knowledge and education is really key. We already know, we've had many conversations in the past the importance of this, but I'm really excited today to be joined by Bilal and Peter, who are going to be explaining their experience and their views and ideas around this particularly informational topic about how financial service providers can help build financial capability amongst its clients and those it serves. Before I introduce my guests officially, let me just do a couple of housekeeping. So firstly, as you'll see, today's session is being recorded. So what it means is if you do have any internet connections during the session, don't worry, we'll be sending you the recording on Thursday. But, and this is where it's more important, we don't want you to just read it yourself. Actually, we hope you're going to love today's discussion, and we want you also to share that link with all your colleagues as well, so that more people can learn about what's going on at Digital Frontiers, but also with our partners who are on the call with us today as well. And secondly, great that everyone's introducing themselves in the chat, and keep going. Let us know who you are, what organization you're from, and what country you're from. That will help us tailor our conversation to you. But also, if you have any specific questions you'd like to pose to the panelists today, please put that in the Q&A function, because that will just help me monitor the introductions and the socialities that happen in the chat and the serious questions that go on in the Q&A function. So without further ado, I'd love to spend a little bit of time really introducing you firstly to our panelists. So firstly, we have Peter Sparreboom. Did I pronounce that right, Peter?
Yes.
Excellent, excellent. And Peter is joining us. She is an instructional designer and financial inclusion expert. And so she's giving her views along with also the thoughts about who she's partnering with, which is obviously Arifu, who has been joining us and putting this webinar together. We're also joined by the lovely Bilal Zia. Again, did I pronounce that correctly, Bilal? Excellent. And Bilal is the senior economist in the finance and private sector development team of the Development Research Group at the World Bank. That's a very long title, but I hope I got that absolutely correct. And Bilal's research is focused on financial development at the household, firm and bank levels, and has published many pieces of work, which I'm sure many people on this call have read, and we'll look forward to also learning more about the newest piece of work that Bilal is going to be sharing with us on the webinar today. So thank you so much, Peter and Bilal, for joining us.
Thank you for having us.
Excellent. And so let's start then. I think, Bilal, you're going to sort of set the scenes for us here. So over to you.
Well, thank you very much for the invitation. This is very exciting. I'm going to share my screen. Okay, great. So I wanted to give a very quick, just to set the scene for the discussion to follow, because I think the interactive discussion is going to be the most exciting part. And this is just to sort of whet everyone's appetite about financial education, why it's important, what we know, what we don't know, etc. So basically, the first question, I guess the first order question is, why do we think financial education is important? Why do we think it's going to be an effective tool for improving financial decisions? So if we think about sort of the financial system, it's fundamentally not a very user-friendly system. We think about financial products, they're often very complex and difficult to evaluate, especially for individuals and households that live in poor countries, have poor levels of education, have never gone to a finance class. They obviously don't have MBAs. So they often face these difficult questions and calculations, such as calculating interest rates. So various loan products might have flat or declining interest rates. Their savings accounts have compounding interest rate, which is a very powerful concept. Very few people understand it. When trying to decide how much to save, how much to put away, how much to spend. They have to anticipate their liquidity needs. They have to think about what the prices are going to be tomorrow, next week, next year. And that's sort of very difficult planning. Long term is very difficult. In addition to that, many of the financial products that are coming out these days are multidimensional in the sense that they're packaged products that you don't just get a loan, but you get a loan and an insurance product. How do we decide? How do we rank them? Is a difficult choice. And then, in addition to that, we have to keep in mind that it is us humans who are making these financial decisions, and as humans, we often make a lot of mistakes. So this is essentially the behavioral aspect that many of you are familiar with. That especially when it comes to intertemporal trade-offs, when deciding how much to consume versus spend today versus tomorrow, we tend to put off sort of bad decisions or difficult decisions to the future, and that could be, well, I could consume today or I could save today. What do I want to do? And a lot of us tend to procrastinate. We have self-control problems, and we sort of come up with excuse after an excuse that, okay, eventually I'll start saving tomorrow. And then when tomorrow arrives, I make the same decision again. So these behavioral factors often inhibit good financial decisions. And if we look at the supply side, also the system is kind of rigged to be fairly opaque. So there's a bunch of research that shows that on the supply side, there's a lack of disclosure and transparency. So for individuals who are not sophisticated, who do not have pre-knowledge on these issues, they tend to be they tend to make poor decisions, not just because they themselves don't have the knowledge, but the system is rigged for them not to actually understand all the choices clearly. And that's clearly a problem. So then the question is that can financial education help and resolve both these constraints? And if we look at the evidence, there's actually very compelling evidence from both rich and poor countries that less financially educated individuals make poor financial decisions. So then the question is, well, do these correlations actually translate into causal evidence? And that's where sort of there's a bit of a excuse me, there's a bit of an initial hiccup in the literature where initial evidence that came through on field experiments, randomized controlled trials, actually showed very muted impacts. In fact, one of the first studies that I was involved with on financial education estimated a precise zero effect on savings decisions in Indonesia. And then there are a bunch of other research that shows that the effects are modest and they tend to dissipate over time. And also that interest and participation in adult financial education workshops tends to be very low. Attendance is very low. And that these sessions tend to be fairly short, and there's a lot of variance across who attends and how effective they are. And generally, interest in classroom-based sessions tends to be fairly limited. So then, if we think about what are the big challenges in financial education, you can think from first principles that behaviors tend to be very difficult to change, especially financial behaviors. It's not just a knowledge constraint, but there might be even something more fundamental like an income constraint. So you can tell everybody that saving is great, but if they don't have money to save, then they're not going to save. And in addition to that, there are sort of these behavioral biases that I mentioned. Again, knowledge is just one part of a multi-arm constraint portfolio that individuals have, and then we want to solve multiple constraints at the same time if we want to move the needle. And then when it comes to classroom trainings, so these generic courses may not be relevant, interesting or informative to individuals, and also skilled and engaging instructors are often difficult to find. And finally, just sort of from being an adult myself, we all have very sticky preferences. It's difficult to change our ingrained habits, especially if we're set in our ways. Somebody comes in and says, oh, you should do something differently. We're going to be very skeptical and not sort of really listen to them, at least at first blush. So this is just normal human behavior. How do we sort of design financial education, keeping in mind these constraints? The initial evidence didn't actually address these constraints. And that's where some of the new wave of evidence is going in that direction. And that's what I'm referring to. There's a promising new wave of evidence that suggests that financial education does actually work when it's well designed, well targeted, and well timed. And we'll go more into that in the discussion phase. But just to give you a flavor in terms of design, we're looking at sort of more interactive financial education, story-based, gamified, addressing multiple constraints. So this is just capturing the attention, addressing those behavioral constraints that I mentioned. Also, the targeting needs to be important, that it's needs-based, adapted to the characteristics of the population it's trying to serve, and that it actually hits you at the time that you need it the most. So imagine that you're a migrant worker in a poor country just about to go out and get a job in a richer country. You are going to have a positive income shock. So that's precisely the time when you could benefit from learning about the benefits of saving, because you're going to have the opportunity to save. Now, similarly, you're a farmer and you're about to hit harvest. Suddenly, you're going to have the opportunity to save. So, timing financial education can be pretty key. And I'll leave you with those thoughts to come up with questions, and we can have a discussion. But I'll stop there.
Wonderful. Thank you so much for that, Bilal. Lots of food for thought there. Thank you for being honest and sort of sharing us with the initial findings. And actually, it's important to acknowledge the differences from before and what we're seeing now. So I'm excited to learn more and discuss about those. But firstly, Peter, really excited to get your views on this.
Thank you very much, Sarah, for having me here. And thank you, Bilal, for presenting the evidence, the old evidence, and also the much more promising new evidence on the effectiveness of financial education. So I would like to really focus on financial inclusion, and that includes getting people, it's not limited to, but includes getting people to open formal savings account and to use them. It includes getting them to use more efficient payment and transfer services, and it includes getting them to select loan products that benefit them and that they can actually pay back. So in these past years, well, actually the past 25 years that I've been working in financial inclusion, I've seen financial service providers actually develop better and better products and making them more accessible and more convenient by investing in digital channels, in mobile banking, in the setup of agent networks. But that has not been enough, we all know, to increase the usage of services. So I see three problems that I would like to share with you. And then I would like to explain to you why I have joined Arifu to help address these three problems. So the first problem, and Bilal talked about that, is that low-income people are often poorly informed. And I wanted to share two facts with you from a recent financial access survey conducted in Kenya. So in 2019, 23% of Kenyans perceived betting, often sports betting, gaming, lotteries, as a source of income. And many of those therefore felt that it was a good idea to take a loan and invest it in betting. Now, no wonder that for financial service providers, it's sometimes difficult to get people to pay their loans. If people do not understand that for one person to win, thousands, tens of thousands have to lose, then there is clearly a problem, and that's an information problem. Another fact from this study, 47% of Kenyans reported losing mobile money from their mobile wallet. 12% reported losing money through mobile banking. Now, again, no wonder people don't put all their savings into a mobile wallet or a bank account if this is what happens. But in fact, the problem is not so much that the money gets lost, it's that they themselves lose it because they're badly informed. When you read more deeply this study, you'll find that people fall for scams and frauds. They don't recognize scams and frauds, or they share their PIN code, or they don't look carefully before sending money to someone else, and they don't put the right telephone number in. So very often it's because they're not well educated, informed that they're losing money. And better product design doesn't solve that. We need financial education for that. And financial service providers benefit from financial education. So problem 2. And Bilal said that financial education is not always effective. And that's definitely the case. We find from research that it really depends how financial education is done and what the content is, how it is designed and how it is delivered. And we find within Arifu the same thing, that financial education needs to be well designed, well targeted, and well timed if we want it to have an impact. And then the third problem, I think that is at least as important, is that there's not enough financial education being given at the moment because it is expensive. Most programs that I know of are paid for by governments or donors. Governments and donors have ups and downs in their funding, and many of these programs are temporary. So if we want continuous financial education and we want everybody who needs it to get financial education, it is important to bring down the costs, to find more efficient, more simple ways of delivering this financial education. Now, these are some of the reasons why I joined Arifu in their quest to find more effective and more efficient ways to do financial education. What is Arifu's solution? Arifu's solution is a chatbot. We use chatbot technology to deliver financial education to people literate and who have a phone, but it doesn't matter what kind of phone. Most of our training is actually delivered through SMS. And we've been able to reach a lot of people already with this kind of training in many countries, and we're still expanding. We're doing everything to make sure that we build this training on the outcome from research on instructional design, on behavioral economics, and on financial education. We talked about the need for good design, for good targeting, for good timing. And so we work on all these aspects. Good design, we try to make the training really engaging. You can use stories when you do training through SMS. You can make it interactive by asking questions, by providing quizzes that actually, when people take the quizzes, they deepen their understanding of the material. And there's many other things that we do in terms of instructional design to make these trainings work. We also tailor the training. All the training that we've developed so far has been designed with a particular target group in mind, and it has been tested on learners who belong to that target group. The exciting thing about SMS and chatbot training is also that it's really easy to personalize, because you can give people a menu with different topics, and people can choose the training that they need. You don't get that in classroom training. You need to follow the standard curriculum. But here they have a choice, and they can just focus on what they need. It takes them less time, and they're more interested in that. Then also, we make it convenient. Already Bilal talked about the importance of offering training at a teachable moment. So we look at occasions where people have a lot of money available because they've just done their sales, and they need to either invest that or put it into a savings account, or maybe just before the planting season when they need a loan. That's when they're receptive to training, and we can time this. And of course, and we've seen this all during COVID. A big advantage of digital training is that it can be consumed where and when people want. This is particularly important for women who have, we all know, less time than men to go off for a group-based training somewhere else, they can do this at the end of the day. They can begin and stop when they want and continue later on. So these are some of the advantages of this particular chatbot solution. It's not the only solution, but we believe it's a good one. There's some additional advantages to SMS training, and of course, you get data. When you are training through SMS, you get data, and we actually share that data with our partners, with the people who help us distribute this training to their members or to their customers. We give them a real-time dashboard that gives them information on the amount of learning that's happening, how many people are learning, and what are they learning, how many messages are they downloading, on what topic. We also like to use this data and compare it with the data of our partners, and see whether learners have a different behavior from non-learners after the training. So we have a whole research department that conducts all kinds of research, from cross-database analysis to actual impact assessments and RCTs. Now, the challenge remains to bring down the cost. And we're working every day to find new solutions for that. I'm really excited about this newest product that we have, which is called the Content Marketplace, where partners and individuals can actually go, and for a monthly fee, they can rent existing courses from our library per month. Or they can also create their own courses with guidance from us, but they don't need to pay us to actually create the course, right? They do it themselves, and then they can distribute these courses directly to their members and their customers. Very shortly, they will be able to do that entirely on a self-serve basis. So, in summary, we're dealing with three problems. Low-income people have poor information. Financial education is not always effective, and financial education can be very expensive. So Arifu is offering a solution through this chatbot methodology. It applies learnings from international research and from its own research, and it is generating data that allows us to actually measure the effect of financial education. Now, in line with the principles of instructional design, it's not good for a webinar to just be one way. We would really like this webinar to be two-way. So I'm going to ask you a question, also because Arifu has found some solutions, but there's many other solutions. Many of you work in financial education or are planning to get involved. So I'd like to ask you a question. I'd like you to write your answers on the chatbot. So this is my question to you. What do you think are advantages for financial service providers of investing in financial education via mobile chatbot? And Sarah, let's just give them 2 minutes to write on the Zoom chat the answer to this question. What do you think are advantages for financial service providers of investing in financial education via mobile chatbot? And I'm talking about the financial service providers investing. And please base yourself on your own experience.
Excellent. Got some great responses coming in already.
Yeah, any time of the day, indeed. Providers get timely and simple answers. Yeah. It's a way also for financial service providers to learn about their customers, right? Oh, there's many answers there.
Many responses coming in.
Super cool. Yeah, and some of these advantages are easy to get. Others you have to do some extra work, but we work with different partners to try to take the most out of this mobile chatbot technology. Yeah, it can be very customer centered. Good. I'm going to stop sharing my screen.
So we've got some great interaction, some great questions there. So I will be trying to pull out some of the ideas that the participants you've all shared so far. But I think what I'd like to ask Bilal sort of first before we come to those questions is, so we talked about some of the characteristics, and you know, Peter and Bilal, you had the same sort of three key things, like the design, the interactiveness of it, that it's targeted towards particular, you know, people or segments of the market, and that it's delivered in a timely manner. Bilal, perhaps you could give us an example of, you know, when financial education has been delivered well and made a great impact. Maybe sort of having something we can all visualize would help us understand exactly how those components start to come together.
Yes, sure. Can you hear me?
Yes, we can.
Yep. So apologies to all participants. I'm technology deprived, so my internet is kind of slow right now, which is why I've turned my face off. So hopefully you can still hear me. Yeah, so absolutely, I can give you two quick examples, in fact. So the first is on better targeting. And this is kind of a key thing to note, is that at times in many of the studies where we found zero or insignificant average effects, which is across the whole population, we don't see average effects. However, when we break the population down into segments to say, well, starting levels of financial literacy, and or men versus women, there is actually where we start seeing some heterogeneous effects, that financial education, even in its earlier form, where the average effects weren't that great, it was still helping people with low initial levels of financial literacy to bring them back up. So that's the one that goes to saying that targeting financial literacy better can go a long way in making it effective. And then the second example, which is very exciting, is where financial education has been shown to be super effective, is actually, it comes from South Africa. One of the papers that I wrote was using television as a medium for financial education delivery. And basically what we did was we worked with a soap opera production company to incorporate a month-long storyline within the regular soap opera around debt management in South Africa. And it was beneficial for many reasons, both supply and demand. So on the demand side, it's a captive audience. So people are watching the soap opera because they like watching TV. We're not forcing them to come to a classroom. We're not forcing them to sit and watch. They're doing this voluntarily. And the idea there is that, can we appeal to that sort of captive audience, not captivity, that captive audience, and essentially teach them financial concepts, kind of like osmosis, that they're doing this because they enjoy it. And in that enjoyment, can they also actually do some learning? And then the second thing is, it has, similar to the mobile phone sort of penetration that Peta mentioned, TV likewise is heavily penetrated. So even in the poorest of neighborhoods, people still watch TV. Maybe they don't have their own TV, but maybe they have a TV in their neighbor's house, or maybe there's a TV in the sort of in the village head's house, and everyone congregates there and watches their favorite shows every night. So it's the supply side is constrained, is relieved. So we don't need to send instructors in every village. The instruction gets to them through a medium that they voluntarily watch. And what we found there was that it actually had significant effects on changing where people are borrowing money from. So they stopped borrowing from expensive sources, such as money lenders, in this case, a hire purchase, and they switch to more formal sources of credit that come along with lower interest rates. So they're making better financial decisions because of this way of reaching them. So that's kind of a really cool example where financial education was really effective. And it also addresses two of the questions that I've seen in the Q&A. One is, well, what if they don't have mobile phones? Well, television is an alternative channel. And the second was, well, how do we reach illiterate farmers who can't read or write? Well, they can still understand speech. So that's sort of another alternative way of getting the message across. Thanks.
Thanks, Bilal. I really like that. It's about going to where the people are rather than expecting them to come to you. So, I mean, for those who have a mobile phone, it's great to sort of appear on that device. And many of us now have, or even without smartphones, even the sort of the low cost SMS, as you mentioned, Peter, works really well as a function. But television or radio, even in some areas, I know, are particularly great ways in which people are already going to those mediums. So if you go to them, they're much more likely to hear that than expecting them to come and sit in a classroom. That sounds really interesting. I love the idea of a community gathering around a radio or television to watch or listen to the programs together, and then maybe even continuing the conversation together further, which is even more deepening the education benefits from that particular concept. I love it. So you touched on there, Bilal, about making better financial decisions. And Peter, I'm going to come to you, because when we talk about savings and access to credit, what are we seeing there? What are we seeing that people listening to or receiving financial education is actually impacting their decisions?
Yeah, well, let's talk first about savings. So many people believe that poor people are too poor to save. But the financial diaries research that was done by Daryl Collins in South Africa and then repeated in many African countries actually shows that often low-income people save a larger part of their income than high-income people. Why? Because they often have fluctuating income or seasonal income, so they have to save. They don't have access to insurance, and they still have to make sure that they have something to eat every day, that they are prepared for emergencies, and that they can make investments in things like education. So the job of financial education is less getting people to save, but getting them to save more wisely. And sometimes it's wise to save in informal devices, and this is what most people do. And sometimes it's better to save in formal devices, and we're encouraging that people use formal devices. But for example, savings accounts are often covered by deposit insurance, and they help people. Saving in a savings account helps people to build up a credit record. So we want people to be conscious of these choices, understand these choices, and make the choices that are best for them. So that would be on the savings side. You want me to talk about loans as well?
Go for it.
Yeah, good. So before, the problem was that there were no loans available for people. But the other day I was reading a study that at the moment there are 50 digital loan providers in Kenya. This is Kenya. It's not everywhere, but it's coming everywhere, right? And a lot of people are falling for the marketing of these loan providers, and some of these digital loan providers are really loan sharks. I saw one the other day in Kenya that gives 7-day loans for 30% interest rate. And people fall for that. It's an active digital lender. So we inform people through this financial education on what to look for in a financial service provider and in a financial product, and we work only with institutions that are ethical and that provide products that actually benefit, that we believe will benefit the customer.
Great.
Yeah. Can I just add one thing to that, to the last part? So yeah, so exactly. So having so many loan providers makes financial literacy or financial education even more important, because we want to equip individuals to be able to discern a good product from a bad product. And I mean, these obviously they're a business and they're trying to make money. And they're smart. They know the behavioral constraints that people face, such as they like to sort of put forward consumption and put away difficult decisions. So they offer 0 down payment or no payment for X number of months. But then in the fine print, it says after X number of months, the interest rate is going to be a gazillion %. So in fact, that is precisely the gist of the storyline that was portrayed in the soap opera that I mentioned, where essentially the lead character fell victim to this temptation, that it was a zero down interest, no interest for 3 months plan, and she just overspent. And then that came back to haunt her when the interest rate finally came due. So that's where financial education can be helpful, and sort of essentially budgeting how much we actually want to spend, and what are our options to finance that spending, because people do have multiple options, especially nowadays.
Mm. I think that's really interesting, because we're not telling people that they have to save or why they have to save, because actually as we've said, some people already know these and already make, but it's about making the wisest choices from the options available. And having just gone through myself, and I'd consider myself a reasonably informed, I would hope, about digital financial services, but myself having gone through a process of trying to find the right mortgage to purchase a house, there's so much information and so many little fine print and so many different decisions and choices that you need to make. And it's actually, you almost, as you said, talked about that timing. It needs to be, there's no point learning about it 3 years ago or even 3 weeks ago. Sometimes it's actually when you're engaged with purchasing or signing up for the product that you need the information, which is, we've got a couple of questions that kind of connect to that from the chat. So I can see that Danielle is asking, and also we had David in the chat asking too, should and how does the education embed into the services or the product design? Is that where we should be and can be embedding financial education? Peter, I'll come to you first for that one.
Trying to unmute. We see financial education as something complementary to marketing or to customer service. It benefits financial service providers to give good information to their clients, and for their clients to be informed. I'm not sure if the example is is right here, but it's an interesting example that I wanted to share anyway. So I was talking to a banker in Zambia. And she said the biggest problem is that we have a high non-repayment rate, or people pay late. Let me put it like that. And people they are afraid of us. Then they hide, and then we can't find them, and then they get deeper and deeper into a hole. Whereas if they would just come and speak to us, we could talk about how to solve this repayment problem. If they really can't repay, then we can reschedule, and if we reschedule, we avoid the situation going out of hand. We avoid having to report them to the credit bureau, and we can eventually lend to them again. But very often they don't know this, and financial education, and particularly mobile financial education, is a really good way to get people to trust financial service providers by giving them the information and explaining to them that it is in the interest of the bank to keep the client. It's very much in the interest of the bank to keep the client. And if learners understand that, they will come to the bank and speak and solve their issues with the bank.
Yeah, I'll add to that. I think there's also a case to be made for financial education, or even just client retention education for the suppliers themselves, for the financial product providers. So as Peter said, it's in some sense it appears that their optimization is fairly myopic. So the short-term optimization, what can we extract from our customers in the short term? And they just often don't think in the long term. Whereas, as Peter mentioned, and I agree, that really their interest should be client retention, because as these clients grow, for example, a small business becomes a larger business, that business is going to become a bigger client and draw more business. Their reputation affects other sort of complementary effects that come from growing. So in general, I think there needs to be sort of education for loan providers as well as loan consumers, to bring sort of.
I think we've lost Bilal again. Hopefully he'll join us back and can finish answering that question. Bilal, are you back with us?
I am. I really apologize for this.
No problem.
Yeah.
These things happen. So you were just talking, and I'm going to ask you another question similarly. So you were just talking about how, taking that long-term view is really important. And we've got a question from Andrew and Marcella, who have asked, is there any data or evidence on that, measuring that return? And in terms of Marcella's question is sort of about if we spend $1 in financial education, as a financial service provider, is there any evidence that brings a return to that financial service advisor? And you're sort of suggesting yes, but is there any evidence behind that yet?
Yeah, certainly, sure. So several points there. So first is that the literature on this is still fairly young. So we've moved on from sort of initial stages where we weren't finding even short-term effects to sort of a fairly consistent body of evidence that's now showing that there are significant effects, that we're not actually barking up the wrong tree, and we are actually hitting something that's valuable. What we are building now is a body of evidence on the long-term impacts, which we don't have currently. So, for example, we have found regarding some other development interventions where longer-term studies have been done, is that we do see initial impacts, but they tend to dissipate over time. So like 5 years down the line, 6 years down the line, we're not going to see any effects of those who are financially literate versus those who are not. We don't know the answer to that. That's an open question, a very important open question in this space. So the one example that comes to mind, and this actually connects with another question that I saw about can we apply financial education to younger populations, adolescents? So I have another paper that I did on financial education for high school students in Brazil. And there we actually saw very strong short-term effects on various financial decisions, savings, credit, perceptions about financial decisions. And it was a well-received study for short-term impacts. And the one sort of question mark from that study was, well, great, you found these short-term effects for these adolescents. Come back to us in 10 years and tell us whether as adults they are making better financial decisions. So we took that challenge seriously. And just now, actually, we're working on a paper where we've gone back to them as adults. It's been 10 years since that initial work was done. And guess what? We're actually still finding positive effects for those individuals who took financial education 10 years ago in high school, and they're making better credit decisions. They are more likely to open a business and be entrepreneurs. So that's actually very positive news, and it's a still draft that we're working through, but something to look forward to that will be coming soon.
Excellent, that's amazing. I mean, we've got a question, the similar question as Austin coming in the chat there about how access to financial information and education is driving adoption of products. So Bilal, that sounds like a really, really fascinating study to follow up on. And I guess a follow-up question to that would be, is age really key? Is that one of the, when we talked about targeting, it is actually going in as early as we can, an incredibly important part of financial education and financial literacy and making the right decisions.
I definitely think so. I mean, I think it's key at all stages, but I think it's just a lot easier. And you also get these sort of longer term effects when you reach individuals early. If we start in adolescence, the sort of the potential impacts are going to be long lasting, because these are individuals who are going to enter the formal workforce or informal workforce, and then they're going to be making financial decisions as they grow. So if we equip them to make better decisions now, those better decisions are going to help them over and over again as they become adults. And the second thing, in terms of making it why it's easier, is because adolescents and school-age children, or even individuals in university and college, they are primed to learn. They show up every day because they want to learn. So their brains are more sort of equipped to absorb some of this information. Whereas when you become an old geezer like me, then you're just like, oh, my ways are set. I don't want to listen to anybody. I know I'm making these poor choices, but I like my poor choices. Nobody's going to change my mind. So it's much easier to do that when you're working with younger populations.
Yeah, I love that. I guess it's like, not trying to change the poor behaviors and habits that we've got into, but actually setting them at a positive point in the first place before before you start making those bad choices. Not assuming that you make all bad choices though, Bilal. I'm sure you made some very positive financial choices as well.
Getting faster internet was not one of them.
And so I'm also thinking, we talked about youth, and often when we talk about, access to, financial education and also financial inclusion, youth is one of the key segments. But the other one we talk about often as well is women and trying to bring some sort of gender equity. And Peter, perhaps you can give us an example there of, how would we target women in particular in financial education successfully?
Yeah, we've done a lot of work with women, and also researched what is the difference between men and women in financial education, and how do we take that into account. In agriculture, we see very clearly that if we want women, because we also give agricultural training, if we want women to participate, we have to give information about the crops that they cultivate and the part of the crop cycle that they are engaged in. With financial education, we find, for example, that when we describe formal financial products, we have to focus on privacy. This is much more important for women than for men, that they are able to keep money in a place without anybody else knowing how much money they keep in that place. So that's in terms of content, but also in terms of delivery. There's different things that we can do to reach women. For example, one is, and I think I already mentioned it, the timing of, it's the timing of invitations to learn. Normally we send an SMS to invite people to start learning. And women are usually very busy during the day, taking care of their business or their plot and their children. And if we send messages later in the day or in the evening, then we get more women to participate. Also, a lot of women don't have a phone, but their husband has a phone. And we find that if we send a message to a man with content that's actually relevant to their wives, and we encourage them to pass their phone to their wives, then some of them pass their phone to their wives and let their wives learn on their telephone. So these are tricks that we can use to reach more women. They're just examples. We've done a paper on that. I think Steph is going to put it in the chat.
Perfect. Thank you so much. I mean, we're hearing, those three key principles that we talked about right at the beginning, the design, the target, the timing. Actually, there's no such thing as a one thing fits all. It's not like you can design a financial education program, put it up on your website and say, hey, come read it, come use it, because that's not what we're hearing is successful. We're actually hearing that needs to be interactive, delivered in mediums that are easily accessible and already used by people. So whether that's television, radio, mobile phones, at school, while people are already learning, that it's places where they already are. And that the timing is really key as well. That actually it needs to be both timely, so perhaps connected very much when people are about to make an important financial decision by signing up for a product or service, or when their financial situation changes, as I think Bilal mentioned around, suddenly, if you're start a new job and your income's about to go up, that's the time when you want to learn about savings or retirement investment plans and things, or even timing in terms of, as you were saying there, Peter, knowing that you reach out to women after a certain time of the day to get them to interact with them, because during the day they're too busy. So design, targeting, and timing are obviously three really key aspects that we need to play around with and create financial education programs using these principles. So we're in the last 6 minutes, and I can't believe we've only got 6 minutes left. I'm sure we just started this conversation. It doesn't feel like we've almost had an hour. So to make sure that we finish on time, what I'd like to hear from each of you really is, what's next? I mean, we're obviously beginning to get some really great evidence to prove the importance of financial education and how to do it successfully, and what the impact and return on that investment is, both for the financial service provider and the individual. But how do we keep this going and learn more and make things as impactful and transitional as we can? So Bilal, let me start that very difficult question with you.
Sure, and I'll try to be brief. I think it connects with something I said earlier, which is we need to have sort of investment in understanding the durability and sustainability of these results. So we are seeing some promising short-term effects, but we want to see whether these effects stick, and which particular kinds of interventions stick better than others. Because that's going to be key to sustainability of impact. And related to this, I think in order to bring the cost down for financial education, which is an important aspect, we want to start thinking about how do we leverage sort of technology more and more in delivery and understanding of financial education. And sort of Arifu is a good example of that. But even within that platform, we want to think about complementarity. So, for example, can we connect financial education through Arifu or through other products to, for example, how does that interaction affect individuals' likelihood or ability to get a loan? So one quick sort of provocation that I can leave everyone with is, for example, can we use people's interaction on a financial education platform as a source to create a credit score for them? So the hypothesis there is that individuals who interact more on a financial education platform will actually be more willing to be good credit risks, or are going to be better credit risks, because they're voluntarily seeking out how to make better financial decisions. And in a world where formal credit scores don't exist, and lenders don't know anything about their borrowers, this can be a great alternative credit score for them. So that's something that could be sort of a really key next sort of future research project that we undertake to learn more about the how financial education can be more effective. And then finally, I would say that I think sharing findings and testing and retesting and building an evidence base is going to be really key to make this one of the sort of most important aspects on how we promote financial inclusion. Thanks.
Thank you, Bilal. And Peter?
Yeah, I think you were very right to say, Sarah, that there are many different ways of doing financial education, and that is precisely one of the challenges of researching the effectiveness. So just to give you an example, with many of our partners, we do so-called A/B testing, right? We design two types of training, and we test them on two groups of learners that are similar in all other ways, and then we see which one works best. But this is A/B testing, but there are options A, B, C, D, E, F. There's an endless number of options in terms of design, in terms of targeting, in terms of timing that we can combine, and somewhere is the ideal. So I would really like to call on financial service providers to consider mobile education as a tool that is that complements marketing and customer service. And I would like to call on donors and governments to invest in testing different ways of doing financial education and measuring that, and then also sharing the findings for many institutions.
Thank you so much, Peter and Bilal, for joining me today to have this conversation about financial education. I think absolutely no one is in doubt of its importance and and actually its role within trying to increase financial inclusion, but getting it right, we're still in the kind of almost experimentation phase, trying to figure out what works for different target groups, in different topics, and how we do that most effectively. And we've had some great conversations. There's also been some wonderful chats. I can see that Danielle and David have also been sharing their views, and Austin and opinions, and trying to actually help us understand, there isn't a one fit solution that works. There's obviously many people that need to come together, work together to figure out how we pursue this going forward. So I hope people have really enjoyed today's conversation. I hope we'll need to sort of think about ways as a community perhaps to come together and continue the conversation happening, because we've had this chat today, but there's obviously still a lot of work to be done, a lot more understanding, a lot more, how can we, what does leverage those behavior changes that we are looking for when it comes to increasing financial inclusion and helping people make the right choices when it comes to their finance. So Bilal, Peter, thank you so much for your time today. We've really enjoyed the session, and I look forward hopefully to continuing this discussion and seeing you all on another webinar again shortly.
And we will answer all your questions.
Yes, those questions we haven't got round to doing so, we'll also aim to send responses to you with the recording as well. Thanks for the reminder.
Thank you very much for having me.
Thank you, everybody. Have a wonderful morning, afternoon, evening, depending on where you are in the world. Bye.
Thank you, everyone, for participating and for contributing to the discussion. And thank you, Sarah, for organizing this. Really appreciate it.
It was great to chat. Have a wonderful time, everyone. Bye-bye.
Bye.
Bye.